Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time, and this week's topic, guys, we're going to talk about trading the chart, not the indicator. There are over 400 indicators out there, all kinds, MACD, stochastic, com channel index, moving averages, all kinds of things, trend lines, whatever, okay? And I see a lot of people with a lot of crap on their charts. And you know what? It's not really doing you any good. I know with newer traders, it's very tempting because you think, oh, there must be a holy grail, there must be an edge, there must be a reason that there are this many indicators out there. But let me think, I want you guys to think about it this way, flip it. If any one or even two of those indicators was so good and so important, why are there over 400 of them? Think about that, all right? So, to be clear, I am not opposed to using one or two indicators. What I am opposed to is spaghetti charts, people that put too much stuff on their chart. So today, we're going to talk about what you really need to look for on the chart, and it's not indicators. So we will talk a little bit about indicators, okay? But I want to show you guys what's really valuable, it's really important on charts. So we're going to talk a little bit about multiple time frame analysis, candlesticks, volume, trends, patterns, etc. All of which you do not need indicators for. All right, so you're going to learn a lot today. Why? Because we're going to simplify your trading to make it much more reliable without needing all that extra junk on your charts. All right, if you like these videos, please click the like button, hammer that subscribe button. I'm Jared Wesley of Live Traders. Let's get to it. This week's lecture topic is trade the chart, not the indicator. So that's a little bit misleading. We will certainly talk about charts, and we're certainly going to talk about indicators. However, it's not just about indicators. We're going to talk a little bit about multiple time frames. We're going to talk about market timing. Like, we're kind of put it all together and really focus on what is actually important when you're looking at trades. And there is a part of this that is cut and dry. That's it. Like, this is the chart. This is what you're looking for. However, as is the case with anything in life, as you gain experience, there is a nuanced, intuitive part of trading as well that sometimes can't always be explained. Today, we're going to focus more on the what can be explained part of that. So sometimes people will ask, why did you like that so much? The pattern wasn't great, it was just okay. Well, maybe it's relative strength compared to the market, this and that. And that's one thing I want to impart in you guys. You know, we have a lot of different amplifiers, right? Bottoming tails, topping tails, and volume spikes, support, resistance. But one of the most important is going to be relative strength and relative weakness. Okay, I'm not kidding. Relative strength and relative weakness is going to be one of the single most important things that you will need to understand in your trading. Why? Because it allows you to make mistakes that you otherwise could not get away with. All right, and that's important because we're not always going to be perfect. But if you can have that relative strength or relative weakness, you might be able to miss one or two little things and still have a good trade. So before we get into that, though, we must first talk about when will the insanity stop? When will it stop? Never. Never. But this one it's a cautionary tale, and this person wrote it as a cautionary tale, so I do give them credit. All right. So this is a person that lost $76,000 trading options, but could have lost as much as $800,000. Basically, that's what was on the line, 800 grand. All right. Story, I almost lost $802,000 today, and I did it for $4,100 in options premiums. Don't do that. I would say that title is about as appropriate as you could be. There's really nothing else to say. I almost lost $802,000 today, and I did it for $4,100. And it's a hard time out loud when you read. Like, think about that for a second. It's not even 1%, right, in options premiums. Okay, I thought I had a brilliant foolproof strategy that the market didn't know, and I was the first to discover, but I was wrong. Let's just skip to the red stuff. After hours happened, and I panicked. My life flashed before me. I had levered up $525,000 in my account, and I also levered up my wife's account for $280,000 for a total of about $800. 800 grand, okay? This wasn't YOLO. It wasn't a double my money scheme, okay? It's funny how they say it wasn't a double my money scheme, but then he goes on to say, I was thinking I could do this 52 weeks in a row, collect 0.5% yield on 800,000 in collateral, and move to Hawaii. Just think about that for a second. So this person was just thinking, hey, I could make 4 grand every week, 16,000 a month, 180 some thousand dollars a year, 192 grand, whatever, and move to Hawaii. Well, yeah, that's not unreasonable. Sure, I would just magically develop something no one's ever thought of, and within a year be a master. But then we skip down to the bottom. Edit, I lost $76,000 closing the position. So while this person definitely deserves credit, right, because this could have been a monumental disaster, like $800,000 worth of disaster, but they closed out for 76. But the lesson here is they still lost $76,000 on 4,100 in options premium. Think about that for a second. Hello, whoa, hello. Now your magic strategy just cost you 6 months, maybe a little less, 5 months. 5 months. So imagine in one day, let's just equate this to the way we trade, right? Entry, stop, target, all right? That means, okay, if you average 20R a month and in 5 months you'd make 100R, you just lost 100R on one trade. That's basically what this person is kind of saying, right? If you think about it in that strategy, meaning I'm taking 5 months of winnings and you lost it on one trade. 5 months of gains lost on one trade. Wow. 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 Okay? Never, ever put yourself in that position. Guys, lose your 1R and walk away. You take a little slippage, the market tags you for 1.5R and it hurts. Walk away. Just do it. I know it hurts the ego. I know it sucks when you lose 1 or 2 trades or 3 trades in a row. I get it. But live to fight another day, right? To succeed, you first have to last, all right? If you can't last, you're going to have a hard time in this business, okay? Don't lever up 800K and risk it all. Levered up. That's wow, okay? Wow, all right? So let's move along. Ooh, what are these? I mean, there's page upon page upon page upon page. What are these things? They are called indicators, all right? Indicators. There are a lot of indicators out there. Hundreds and hundreds and hundreds of them. 400 or 500 of them. I don't even know what the exact number is. I just know that there's probably somewhere in the neighborhood of, I don't know, 200 of them right here, 150 of them right here. I don't know. There's a lot, though, okay? Indicators are not all bad, so don't think I'm coming and just dogging on indicators. It's not like every indicator is the worst thing ever. It's not that. It's not the case. But there are a lot of them. And how do you know which ones are worth it? I mean, FX roll rates, move AOP lines, swing index, tricks. Yeah, I don't know about that one. Anyway, there's a lot of them, okay? There's a lot of them. My goal today is to help you guys focus on what's really important, which is price and volume. And we'll get there, okay? But it's also to not say you can't use an indicator. You can. Just don't use too many of them. I'm okay if you use 1 or 2 indicators. Just don't go nuts with it because you can. It becomes like a drug. Because what happens typically, and this is what I've seen from my experience, is you'll be trading, you'll kind of hit a plateau or you'll hit a wall, right? And you'll sit there and go, man, what am I missing? And then you'll come across somebody else, some guru, some moderator, maybe a friend. It doesn't matter. But you'll come across another trader who appears to be doing very well. And they'll be like, oh, dude, it's because you don't have the MACD on there. Duh. That MACD crossover, when that happened, oh, unicorns fall out of the sky. And then you look at their P&L and they're like doing really well. And you're like, well, shit. Had I known about the MACD crossover all this time, I'd be driving a Bugatti instead of a Honda Civic. Wrong. Doesn't work that way. Okay? If it did, there wouldn't be a need for all these indicators. So my point simply here is that just is the general point of today's lecture. Indicators are okay. Too many indicators are not okay. Pick 1, maybe 2. Okay? It's like monitors. You go to somebody's house and just because they have 23 monitors doesn't make them a good trader. Unwall trades off 1 damn monitor. In fact, he trades off a laptop. It's like 1.25 monitors. Got one of those like Asus that has a little monitor on the keypad too. 60, 70, 80K a month. One. So don't get caught up in how many monitors somebody has, how many indicators they have, okay? Get caught up in what's working, what's best for you. And trust me, too many indicators is going to confuse you more than help you. So, indicators are subjective and usually a crutch for newer traders. Why? Because they're grasping at straws. They don't really know what they're doing. So they're like, well, yeah, give me some of that too. I'll take some of that too. I'll take some of this too. Seems to work for this person. Seems to work for her. I'll try that too. Right? Only price and volume are actually objective. Right? Indicators, almost all of them, lag price. Right? So price, by definition, has to lead any indicator. All right? Indicators can't happen without price, right? You have to have some form of price action to have an indicator based off that price action, right? Chicken and the egg kind of thing here. But in this case, price does come first. There's no ifs, ands, or buts about it. So focus on the price, focus on the volume. Use an indicator maybe as a guide, but not as the be-all, end-all, because they do not represent actual support and resistance, okay? They're subjective areas. Now, can subjective areas act as support and resistance from time to time? Yeah, self-fulfilling prophecy, right? It's possible, but price is the number one thing you're going to focus on. So again, I am not against indicators. I'm against too many indicators. One or two, I think that's okay, all right? So now, what's really important? This slide, this is an important slide, okay? This is a really important slide. So it's funny, I just saw like 5 people log off. Oh well, you probably missed the most important slide of what we're going to talk about today, okay? Multiple concepts converging in an area, more specifically, discernible patterns, bottoming tails, topping tails, support, resistance, retracement levels, change of color, balance of power, shifting from buyers to sellers, sellers to buyers, increased volume, ending versus igniting volume, stock showing good liquidity, enough volume to actually trade it, stock within its average trading range, because if it's super crazy extended, the odds it goes higher are lower, right? Stock is not up 3 or more bars upon entry. Stock showing relative strength or weakness to the market. These are all of the really, really, really important things. And note, none of those are indicators of this nature. None of them look like this, right? You don't need these things, okay? So when you think about what you want to have on your chart, think about how you can use the actual chart as your main guideline, okay? I'm not saying you can't use an indicator. Just think about how the main chart is your guideline. So when you see that retracement level, when you see a buy setup, or when you see a bottoming tail, when you see relative strength, that's the core of what you're trying to accomplish. So focus on that. So after getting all of those things, then you can look to see if there's an indicator confirming what you're already seeing. Note, you have to already be seeing something before you can confirm it with an indicator, okay? It's very, 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 very important, all right? Use these things. Remember, I always talk about a pre-trade checklist, okay? Most people, they either don't have one, or if they do have one, it's in their desk drawer somewhere, and they miss 1 or 2 things. You don't want to be that person, okay? All indicators calculated from price and volume. Is there any other supply data? Nope, price, volume, and time. That's it, Peter. If there is one, I don't know of it. There may be, but I don't know of it. That would represent 99% of all indicators calculated from price, volume, and potentially time. Okay, so less is more. New traders lack confidence. They lack knowledge. They blindly follow gurus. New traders are always looking for an edge. Well, looking for an edge is an okay thing, but you're not likely going to find it in an indicator. And if you do, it's one of the last edges that you'll find. Okay, now again, I'm not poo-pooing all indicators. I'm just saying, focus on what really matters. Trust me, your learning curve will be much, much, much faster than trying to discern what a stochastic is, or what a comm channel index is, or what an RSI is. Forget about it, okay? New traders also have no idea what they're doing. And this is why they grasp to so much of this esoteric, subjective indicators, okay? Price and volume, that's everything, right? And think about it. I've said this before, but every time somebody places a trade, that trade forms a tick. That tick forms a bar. Those bars form charts. Those charts form trends. Those trends form patterns, and those patterns are what we trade. And it doesn't matter if it's Joe Schmo in Louisiana or if it's Michael Jordan or Warren Buffett. Every person is represented in that chart. Every person. Okay? Follow the chart. When you see an indicator, sure, there might be something there that helps you, but only after you've looked at the chart. So let's take a look at what you don't want to look at. I've shown this before, so some of you have seen this. This is what you want to stay away from. Okay? How do you know good liquidity? You know good liquidity by having liquidity requirements. I mean, you have liquidity rules. How do you know a good trade, Sherry? By having rules on what's defined as a good trade. Yes? Does it have a bottoming tail? Is it at support? Right? Is it on a 50% retracement? Does it have a volume spike? Well, it's the same with liquidity. So you should have professional trading strategies talks about at what time of the day, 9:35, 9:45, 10 o'clock, 11 o'clock, noon. What are the minimum volume requirements? That's how you know good liquidity. All right. What in the world is this? I mean, I'm not sure Neo in the Matrix could figure this thing out. I mean, I am looking at it, trying to find something here, and I'm really like just kind of scratching, trying to move like, you know what I mean? Like trying to climb out of one of those Pandora's boxes, like, all right, let me push this line away. Let me push that line away. And all of a sudden, oh, I finally get to the candlesticks. Oh, look, there's a buy setup in there, right? And you sit there and you're like, did I really, really, really need 9,254 lines on this chart? And all this crap at the bottom, stochastic, slow, open interest. I mean, did you really? Did you really? No. I mean, there's a support line in there. There's a trend line in there. And there's God knows how many other lines in there. Rethink what you really need on a chart, guys. Okay? Well, obviously, right, Daniel? Obviously. But you sit here and you're looking, you're like, yeah, Fibonacci retracements are on here. That's a lot. Okay? What I want you guys to think about is this. I want you to focus on the chart. There is one indicator on this chart, and that indicator is a 20-period moving average on this particular chart. Okay? Everything else is just price and volume. Price being those red and green candlesticks, and the volume being obviously the volume at the bottom. So when you look at this, you go, okay, if this is my daily chart to the left, 1, 2, 3, 4, 5, 6, 7 days up. A stock that went from close to 55 to 67, and it did so in a short period of time. And then you wake up, it's already on your chart because it's extended and far from the moving average. It's far from support, right? It's moved quite a bit. And then this happens off the open. It rips from 64 all the way up to 67. You sit there and you're like, Daily's extended, 2 minutes extended. What am I going to get here? I'm going to get a parabolic play, a 2-minute parabolic. But again, it's not just a parabolic on the 2-minute, because a $3 move on the 2-minute is, it's a bit extended, but it's not insanely extended. A parabolic move combined with a daily parabolic or pseudo-parabolic or extended daily chart, now this becomes a much, much, much more reliable play. Why? Because we focused on multiple time frames. We started with an extended daily, and then we got a 2-minute chart that just ripped. Note how far it is from the moving average. Note this thing was basically like a little 2-minute buy setup that turned into a parabolic. Note the topping tails. Note the volume spikes. Note the wide range bars. Look at yesterday and look at the bars today. Look at yesterday, look at the bars today. These are 50-cent bars on a stock that typically does about what, 10 or 15-cent bars? Okay? And it's got 1, 2, 3 of them in a row, another one up here, and then look at the size of the volume here. I mean, you had a stock that was kind of doing right in the, 100,000 range every 2 minutes. Now it's doing a million shares every 2 minutes. There's some significant, serious interest in this stock, okay? Topping tail, doji bar, you're already thinking about it. Right here on the doji bar, right there, you're thinking, okay, I want to short this stock right here, right? I want to short this stock right there. Well, it doesn't. It actually gives you a better entry. It peekaboos up, leaves a massive topping tail, not even a doji anymore, a topping tail. And now you're going to short it at 66.50 and your stop's at $67, and look at the volume. You got this beautiful ending volume up in this range, okay? Far from the moving average. You're going to short 66.50, stop 67. First target is 50% retracement or the moving average. In this case, that's roughly 65.50, which is about 2 to 1. Now, I don't know about you guys, but real quick, I don't feel like I needed really anything here. Moving averages, okay, there's moving average line 1. We took one of these 200 and we used that. We didn't need positive volume index or PPO oscillators. We didn't need volatility standard deviation, time remaining in bar. I mean, come on. We just went to the core, and the core is candlesticks, red and green candlesticks, okay, with volume and maybe an indicator. Again, you can use one or two. And to me, this is pretty clear, right? I mean, I don't think this is hard to read. We use the higher time frame, drill down to the lower time frame. We look at the candlesticks. They tell us just about everything we need. We look at some volume to confirm what we're seeing. Price tells us what is happening, higher or lower. Volume tells us how it's happening, commitment or a lack thereof commitment. Okay, this tells us, wow, there is ending volume, because that's the kind of volume that you're going to get, right, after you're up 1, 2, 3, 4, 5, 6, 7 bars in a row, and then you get a volume spike that's massive. 7 bars up, far from the moving average, wide range bar, and a volume spike, ending volume all the time. And you see the daily extended. Wow. You don't need that page of indicators. Let's take this one. Okay, what do we have here? A stock that has 2 moving averages. There's a 50 MA on the daily. There's a 200 MA on the daily. So there's 2 MAs here. They're the only indicators on the chart. Note there's not one on the 2-minute chart. Okay, so the stock's moving up, moving up, moving up. It pulls back 1, 2, 3 days. A little bit of a bottom. You have kind of a mediocre buy setup, but nonetheless, the stock is gapping over it and should give us room up to this $55.50 to maybe $56 range, the top of the topping tail. Okay, so what happens with the stock? It gaps up and opens near 51, a little bit above 51. Well, that's good, because that's exactly above the red bar. So that's good. Daily chart is in an uptrend, looks good. Okay, got a little far from the moving average, had a pullback. A little bit of a deeper pullback to perhaps 45 would have been better. It would have been better, okay? But we're not going to marry the stock. We're going to trade it on an intraday. So it gaps up over this red bar, 51, and rips. Okay, not much you can do with that. Then it pulls back, gives us a buy setup right here at 52. Then it retests, confirming the buy setup. So if you missed the first one, you can take the second one. And then it rips higher and went to 54.72 because it had lots and lots of room and ended up at this point in time being a 2-hour trade and made a couple grand. Note, there are no significant indicators on this chart. There's 2 moving averages. There are not 200 indicators here. Focus on what is important. Bottoming tails, volume spikes, narrow body bars, doji bars, etc. Okay, uptrends on the daily chart, multiple time frames converging. Okay, don't worry, you're going to see a lot more. What about this? All right, this was Tilray. This is a stock that the daily chart's honestly a little sloppy, right? It ripped up over this pivot right here, got choppy, left a topping tail, pulled back, but it did pull back to an area of support, right? There was a bottoming tail right here, and then a red bar right there, and then it gapped up actually and opened somewhere in the $7.80 range. So it actually completely gapped over this red bar. So it gapped up, left a topping tail, and then you get a big wide range red bar. Now remember, we generally do not like to buy straight into wide range bars, especially red bars, right? So we did not take the first entry. Did not take, be clear, did not take, you can see the timestamp, did not take the first buy setup. I need more time. I need more confirmation. This could just be a little fake and shake, right? Did not take this little 3-bar play. It's into a wide-ass red bar. But what sold us on this trade? I remember this like it was yesterday. Well, it was only a couple weeks ago. That. Is that enough that's? This picture of money, this bottoming tail, the stock was about to go higher and then whoop, whoop. It shook the tree. And the buyer said, no. We are stronger than the sellers here. It's kind of like Dikembe Mutombo, no. Get that out of here, right? Boom, came right back up. Kind of hanging out in this range, right? Boom. We take it at $7.69, stops below the low of the day. We got our target at 810, made a couple R on this thing. There it is. It was a great setup, Carol. You know what I mean? On that TSM you're talking about from today, and I missed it. Note, it's very important, guys. I am not kidding on this one. We don't just randomly buy into wide range bars. There's a reason this is a wide range red bar, and the reason is sellers are in control. How do we know down here at 760, how do we know just because there's a bottoming tail, magically buyers have taken back control? We don't know that. We just don't, because this wide range red bar is something you must take seriously. One little bottoming tail is not enough for me. Bounces back up, getting better. Why? 50% retracement into the wide range red bar. Now, buyers are beginning to what? They're beginning to have a larger impact. They're beginning to show more commitment into the enemy territory, which is the wide range red bar. But we still didn't take the 3-bar play. And then this shake told me everything I need to know about this stock. Wow. Buyers are really committed to not let this stock go below 750. Right? They bounced up here, big green bar, big time shake, bottoming tail, buy it right here. Every time you see this pattern, assuming it has a nice daily and void, take it. Take it. Okay, moves up. We made some money. We moved on. Okay, so very, very, very important. All right. How important is average trading range? It's very, very important. Why would you want to take a stock? Like, for example, let's take a look at the daily Tilray. That bar right there on this day, right? It went like, I don't know, $1.20, whatever it is. Why would you buy the high there? You wouldn't, because it's already gone $1.20, which is about 3 times the range this stock typically goes. Why would you buy a stock that's up 3x? You wouldn't. Not the high of the day anyway. Maybe a significant pullback, perhaps, but then you have to question the strength, right? Igniting volume, ending volume are all important. Resting volume is important. All volume is important, okay? All right. How about this? How about we get perfect picture on 2 different time frames? Daily is in an uptrend. Rising 50 MA on the daily, rising 200 MA, chopping around in this $38 to $40 range for about 3 weeks to a month. March, April, right? What do we get? A wide range igniting bar that takes out this red bar, takes out the topping tail, and looks poised. Don't you love that word? Looks poised to go higher. Next day is a narrow range resting bar, right? Well, our goal, find an entry somewhere around $40. Somewhere around $40. Okay, so what do? We drill down to a lower time frame. Note, favorites, Halliburton over 40. This was 6 minutes before the market opened. I have no idea that this 1-minute chart is going to present itself. Okay, so 6 minutes before the market opens, we're in not in Halliburton, but we're looking at Halliburton over 40 because the daily suggests that we should. 6:31 in the morning, Hal 40 by 39.60. 6:33 in the morning, Hal stop use 39.70. 6:35, there's our target. Stop to break even at 40.30. Okay, so in this particular case, I jumped in a little bit early, not much, a few pennies early, like 97, I believe, is where I actually got filled on this, like 39.97. So yes, while the proper entry was really 39.90, okay, we waited for the whole number. If you actually looked at this, I think the proper entry is like 39.92. I don't remember exactly, but I believe it was something like that. We waited the extra 8 cents, 10 cents to make sure it was over the daily, and we used a slightly tighter stop down here to make sure that we had enough risk to reward. The stock moved up, and it ended up going, I don't know, 70 cents. Made a couple R on it. Okay, made a couple R. So again, note, where are all the indicators? They don't exist because you don't need them. All right, so let's go pre-market. Yes, this is a little bit older. Okay, it's not super new. It's from, I don't know, 6 months ago. Okay, so this is the dollar gainers and dollar losers list. Dollar gainers, dollar losers, pre-market. Pre-market. So I see a 2-day consolidation after a large move up on the 60-minute chart. Right? That's a 60-minute chart. You can see it right there. Okay, large move up 1, 2, 3, 4, 5, 6, 7 bars. But what's the problem? If it gapped up this day, which it did, I can't buy it. The 60 is too extended. Right? Extended into resistance. Not a good look. Gaps up, what happens? Pulls back the next day. Next day, chops around. So now, after an extended 60-minute chart, we have 2 days of consolidation. Now it gaps up over that 470 area to 474. This is pre-market, 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 pre-market. Okay? This is 9 a.m., 9:05 a.m. All right? It's up 2.5%. Completely in the wheelhouse, unlike CVAC, which is up 41%, would never touch it. So this is pre-market. 248,000 shares in the pre-market tells me there's a lot of institutional interest in this. Okay? That's NVIDIA in the pre-market. Where's the indicator on this chart? The answer? There is none. There's nothing here. I'm scanning for gaps and there's no indicator. I might use a moving average, a 50 or a 200, but that's about it. All right, we go down. This, I know it's a little bit smaller. I apologize for that. It's hard to kind of fit them both in here without using too many slides. This is the same exact stock that we just saw in the pre-market. See the two little doji days down here on the daily chart? Clear, clean uptrend. It's above the rising 200, okay? Note, higher highs, higher lows, higher highs, higher lows, little breakout right there. Consolidation breaks out again, gaps up. Drill down. Wow, this is all pre-market data right here. See the volume to the left of the volume spike? That's all pre-market. Okay, all pre-market. So, wow, what a seriously nice pre-market consolidation at 475. Guys, where did we need to get over on this? We need to get over 470, right? The last slide showed us that. And then I come in and I'm like, wow, look at this. From 830 to 930, it holds this. This is a stock you might get aggressive and buy and nibble some in the pre-market, give it a super wide stop, and then when the market opens, you might be in this at 9:30, 9:31 in the morning. You might be in this using this lengthy 1 hour long, 5-minute pre-market consolidation breakout. And I guarantee if you put a moving average to this, it would be sitting on it. And you might give it a wide stop. You might say, you know what, because it's pre, I'm going to give it $5. And that's okay. And even if you gave it $5, it still went 4 to 1. Thing ripped right off the open and never looked back. There's not an indicator on here except for the 200 MA on the daily. We did nothing. Why do you need all those indicators? Take the higher time frame, find a bias. A bias is higher, lower, neutral on a higher time, 60-minute chart, daily chart. Drill down to a 2-minute, 1-minute, 5-minute, 15-minute, and find a damn entry. Don't need an indicator to tell you where the entry is. There's no indicator in the world that's going to say that's a great breakout. It's a MACD crossover, so now it's a better breakout. Get out of here. It's a perfect breakout. Market opens, rip. We're going to do this all day long. We're going to do this all day long till I get this in your guys' heads that you don't need those indicators. Let's do it again. 60-minute chart on the right, 60-minute chart on the right. What do we have over here? A stock that ripped, went higher, and then just got smacked. Red bar, red bar, red bar, red bar, red bar. Comes back up, you get a little wedge, chops, 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 chops. There's something going on here. Between 145 and 155, there's a battle going on here. There's a fight going on here, okay? So you look at something like this and you're like, okay, there looks to be buyers stepping up sooner and sooner. The buyer stepped up down here at like, I don't know, 142. Buyer stepped up here at 146. Buyer step up here, a little above 146. Buyer step up here at 150. Note, higher low, higher low, higher low, flat top, ascending triangle. The negative is this little flagpole, but it created the void. That smooth pullback creates the void back up. So we're continuing to put in higher lows and an equal top. So 155 is that pressure cooker, right? It's that pressure cooker. Bangs its head, bangs its head, bangs its head. Eventually the sledgehammer is going to pop the top off. And this thing's going to explode over that area. Okay? So you're above the moving average. Note over here, the moving average is kind of in the middle of everything. You have higher lows. You're now above the moving average. And the goal is to get above 155. Okay. This one's a little tougher. Why? Because we're not quite at 155. We're at 154. So what do? This one is one of those, wait for it to break 154, go up above 155 and buy the first pullback. That's a possibility. Buy it at 154 and hope you're right. That's a toss-up, right? For me, I got in this at 154 and I thought, okay, this is definitely a problem, this little red topping tail. Okay, but the momentum that this stock has displayed from this 153 area, the level and depth of retracement here is significant. And all of the higher lows said, you know what? I think this is worth the risk because of the gap and the move up subsequently, right? So while I would totally be fine and absolutely support you if you said, no, Jared, I didn't take this at 154 because it didn't get above 155. I'd say, you know what? Good for you. You followed your rules. Better be safe than sorry sometimes. I felt that this was acceptable. So if you get in at 154, you can add at 154.45 on the 3-bar play. It rips, pulls back, and rips. All right? But the point we're getting at here is we're going through a checklist. We're using the higher time frame to begin, drilling down to a lower time frame. And all the while, higher time frame, look at our checklist. Lower time frame, look at our checklist. When the checklist look too good that we can't pass it up, then we take the trade. And it has nothing to do with indicators. Nothing. Yes, there's a moving average here. Yes, there's a moving average here. That's about it. All right. Here's another one. What do we have? Higher time frame, 60-minute chart. Gapping up. Okay. 130 seems to be the line in the sand. Above that, there's void. At least to 132. At least to 132, maybe higher. So we look at this and we're like, okay, this is a stock that's put in lower high, lower low, lower high, lower low, lower high, equal low. Good sign. So equal low and now possibly a higher high. We might be able to take advantage of this transition. Oh, what is it? What is that? Oh, that's the SPY. The SPY's getting taken to the shed. The SPY moved up for the first 6 minutes of the day, 2, 4, 6, and then got crushed. It went lower 1, 2, 3, 4, 5, 6, 7, 8, 9 bars in a row. During this 9-bar pullback, what did Nike do? It stayed sideways, put in a nice bottoming tail shake, went sideways, and then put in a big-ass green bar. Wait. The market's still going lower, and Nike's putting in wide-range green bars with void above 130. Where's the stock at pretty much? 130. Where do we need it to cross? 130. What's the market doing? Getting crushed. What's Nike doing? Pushing higher the days. This higher time frame void, relative strength, lower time frame pattern. Guys, I am telling you flat, they don't get better than this. This is going to be one of the greatest trades you'll ever see. Because that level of extreme relative strength is hard to find. And then when you combine that level of extreme relative strength with the fact it gives you a perfect 4-bar play on the 2-minute and the daily has void above 130, like you've run out of excuses. You have to take the trade. And I chickened out. Flat. I chickened out. Right? Took a winning trade earlier and I was like, I'm going to rest on my laurels. Ended up being probably the best trade I've seen in a month. Probably the best trade I've seen in a month. Okay? This was a beautiful, beautiful, beautiful trade. And you look at it now and you just shake your head and you're like, it's like turning down Halle Berry. You just don't do it. Right? Beautiful 4-bar play at 130.25. There's your stop loss, 50 cents. Guys, this thing went $3. That's 6 to 1. Look at the market, for goodness sakes. Can we say on its own page? Can we say on its own page? Burn this into your minds. Burn it into your memory banks. This is perfection. Higher time frame, nice gap, room to move higher. Lower time frame pattern, super huge, significant relative strength to the market. This is what perfect trading looks like. If that were to ever stop out, you just tip your cap and say it just didn't work, because 9 times out of 10 it will work. I got to move on from this. I can't even look at it anymore. It hurts my eyes. It's so nice it hurts my eyes. It's like I'm not worthy, right? I feel like what's that guy's name in Gangs of New York? When it's like I couldn't look him in the eye, so I cut my eye out, right? That's the way I feel about Nike on that trade that day. Not worthy. Okay, let's move along. Let's take a look at another one. This is another recent play. Oh, wait, yesterday. Okay? So, Johnson & Johnson. Let's start with the higher time frame. Imagine that. We gap up over a red bar, over a topping tail. So we didn't gap over the topping tail, but we moved above the topping tail. But gapping over this red bar in an uptrend is significant, right? Gapping above the red bar in an uptrend. That's a nice daily chart. Should be on your list. Let's drill down. So what do we see? Stock gaps up, kind of gets a little red, and then a wide range green bar comes in play. This is a 1-minute chart. This is like 9:32 in the morning. And then we get three consolidation bars between 182 and 181. You want to guess where this topping tail is? I'll give you a hint. It's at 181.50, 181.40, okay? Right there, that topping tail. We're at 182, so we're above the topping tail. There's nothing here anymore. Drill down to a 60-minute chart, 15-minute chart. There's nothing here. There's just void right there. Just void right there. What's the market doing on this day? Ripping, right? Gaps up, moves higher, pulls back, moves higher. Well, great. This has relative strength with the market, right? While the market pulled back slightly, Johnson & Johnson ripped higher. So, yes, it's not as extreme as the Nike relative strength, but it absolutely has some relative strength to the market. So we know the daily has room to go higher. We know there's some shock value. We know we're above the topping tail. Drill down. Oh my goodness. We take out a red bar here. Then we consolidate for 3 bars. 182 by 181. My goodness gracious. It goes up 4 to 1. It goes up $4. In fact, your target would have been 184. Why? Because that's where this red topping tail is. That's still 2 to 1, which is enough for us. This is what really good trading looks like, okay? And we are finding them on most days. The question is, are you taking them? I didn't see this yesterday when it happened. Unfortunately, I saw it a minute too late. I saw it halfway through this big-ass green bar when it was at like 182.70. I was like, you've got to be kidding me that I just missed that. You look at the daily, you look at the market, you look at the pattern, and you just sit and shake your head. If you see it, don't hesitate. Take it. Okay? Now, when it comes to indicators and respecting them, the 200 period moving average, specifically on the daily chart or the 60-minute chart, is really the one I look at most. All right? For me, when I am looking at gaps in the morning, pre-market scanning, dollar gainers, dollar losers, the 200 period moving average is really the one I am most focused on. Okay, it's the one that hedge funds use, that market makers use, all the big boys use the 200 period simple moving average. Okay, so you look at this stock and it's kind of hanging out here, right? Chop, 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 chop. I mean, we're talking, I don't know, 5-6 months. It's stuck between 10 and 12, just over 12, right? Declining moving average, staying under that area. And you're going, well, why are you showing it, Jared? It's $1 away from the MA. You're right. But now it isn't. Same chart. What happened? This thing gapped up almost into the MA, just below the MA. And note, there's resistance here. So we don't just have a moving average. We have a moving average just above resistance. I mean, 1, 2, 3, 4, 5, 6, 7, 8, 9 times this stock has been smacked at the 1250 area. The moving average happens to be just above that area. And this stock gaps right into resistance, and the moving average failed. There's too much resistance, and the moving average confirms it. Note, I'm looking at the resistance first, the moving average second. There's too much resistance, and the moving average there helps me confirm that this is not something I want to mess with unless or until it gets over or above that area. 200 MA is a serious MA, respect it. How about this? Oh, this was yesterday too. So, plug, nice gap, right? Took out this little doji bar, took out this bar, took out this topping tail. See that topping tail? But I want you to take note. There's a 200 period daily, 200 period moving average right in that, I think it was like 2830 area, somewhere around there. 2830, see that little red box right there, right there. Okay. So gaps up, pulls back, rips, pulls back, rips, and then this. What a nice buy setup. Somebody in the chat room mentioned this. They took a 15-cent stop loss and they got their 2-3 to 1. This was another nice play. And this, I don't want to go off on a tangent here, but one of the challenges about being in a choppy market that lacks follow through is having confidence to take some of these trades, right? So we looked at Nike, we looked at Johnson & Johnson, and we looked at Plug now. Nike, I had enough time to take it, and I just shriveled up. Instead of brass in my pocket, I had little raisinets in my pocket, okay? Johnson & Johnson, flat out, just missed it. That was not a decision. I wanted it. I just missed it. Plug was a decision. Chose not to take this as well. I thought, oh man, follow through is really tough today. I don't know if I want to, take a chance on this. Foolish, right? The stock had the room. It had the pattern. It put in a higher high right here, higher low, and a higher low. So you have a higher high right here. I guess you could argue this is a higher high. It's hard to argue that though. But a higher low here, higher high here, higher low here. Beautiful. 50% retracement. If you had a moving average, it would be very close to the moving average. Doji bar, all of the goods, right? In a market that was trending higher all day yesterday, and a nice gap. But where did the stock stop? Where did the stock stop? Where did the stock stop? Right at the daily 200 period moving average. It went up here and got its head smacked, and it closed the day below that area. Respect it. Respect the 200 period moving average on the daily chart. If you have a stock that's trading right into it, or you have a target area that's near it, maybe lower your target slightly. So for example, hypothetically, if you took Plug, and let's say your target was 2850, hypothetically, probably wouldn't be, that's a huge target. And this moving average is 2835. I would lower my target to 2830. I would try to get out before we touched the moving average. Yes, it's an area, so it could go a little below it, a little above it, etc., and so forth. Okay? So the second pullback here, this is actually a decent pullback, but what I don't like about the second pullback right here is the overlap. Note how much overlap. You have a green bar, that's great. Got completely engulfed by this red bar. Then a topping tail here, this is a challenge. Maybe if you drill down to a 1 minute, maybe there's a retest, but the overlap on the pullback is a concern for me, right? And it stopped there again today, Berto is saying. So Plug stopped at the same area. Respect the 200 MA on the daily. So guys, indicators, they are subjective and usually a crutch for new traders. Don't use them as a crutch. Price and volume are objective. They're what you should be focused on. By definition, price must lead all indicators, okay? I'm not against them. I use moving averages, 50 MA, 200 MA. I even use VWAP, volume weighted average price, right? But I'm against too many. I'm against charts that just look like spaghetti. I don't think you need it, okay? And this slide, very important. Focus on this, guys. Multiple concepts converging in an area, and please respect relative strength and relative weakness, okay? Get a discernible pattern. Then look for things that make the pattern better, right? Look for things that make the pattern better. All right, bottoming tails, topping tails, wide range bars, narrow range bars, retracement levels, prior support area, change of color bars, balance of power, shakeout bars, pictures of money, increased volume, relative strength, relative weakness, not extended within its average trading range, market timing. Check, 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 take the trade. Check, skip, 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 check, check, skip the trade. Have a pre-market checklist. a pre-trade checklist, all right? After getting all of these things, then you can look to see maybe if there's an indicator confirming what you're already seeing, all right? And let's just, for fun, just go back one more time so we can leave on a positive note. Let's just have a moment of silence and stare. That's a nice chart. That's a really, really, really nice chart. Okay? Really nice chart. Do more of this and less of the other stuff. Do more of this and less of the other stuff. If you do, yes, you will take fewer trades, but your accuracy will improve significantly, but most importantly, your bottom line, your P&L will improve the most, okay? That is where all of this comes into play, okay? Be diligent, right? Be diligent in waiting for these things, okay? So, I hope that you guys learned a bit about why indicators are not that important. They are secondary to price and volume, and more importantly, what you need to focus on to be a great trader. Guys, it's really quite simple, but what gets in the way is that thing between our two ears, our brain, which has an ego in it. And that ego just gives us a little bit of FOMO, a little bit of ROMO, whatever it is, and we're like, I gotta take that trade. Oh, so-and-so took that trade, so I have to take that trade. Lower your frequency, take higher quality, you will get better results. Have a pre-trade checklist. Start with a higher time frame bias, drill down, and your number one thing you want to always look for is relative strength and relative weakness. Facebook is a great example of that today. I just couldn't find an entry on it, but it was a great example of that. So I hope you guys learned a little bit about how to make your trading better. I am Jared Wesley of Live Traders. We'll get back at it again next week.